There are three types of installment agreements that you can make with the IRS. What is an installment agreement? Well, an installment agreement is simply a payment plan. If you cannot afford to pay your full balance or your full liability with the IRS, in certain circumstances they will let you break that up into payments, and they call that an installment agreement. An installment agreement is actually a term of art. It's a fancy lawyer phrase, or IRS phrase in this case, that means a payment plan. And there's three types. I'm going to go over those three briefly here. The type that most people want to hear about right now is what's called, it's under the Fresh Start Initiative. It's actually called a streamlined installment agreement. If you owe $50,000 or less to the IRS under most circumstances, and you can full pay that obligation within 72 months, the IRS is going to go ahead and break that up into small enough payments so that you can get that thing paid off in 6 years. The second type of installment agreement is what I call a classic installment agreement, and it goes like this. If you owe more than $50,000, or if you've defaulted on installment agreements in the past, you're pretty much stuck with what I call the classic installment agreement. The IRS looks at your financial situation using either a Form 433F or a Form 433A and a 433B if you have a business or if you're self-employed, and they determine using their allowable expense standards how much you can afford to pay on your installment agreement payment, and it usually doesn't turn out particularly well. And that's because their allowable expense categories are absolutely ridiculous. So you could end up in a situation where you owe $100,000 to the government, you make $10,000 a month, but they want you to pay $7,000 or $8,000 a month toward that obligation, and that's obviously not a win-win for anybody. You're not going to be able to make those payments, and the government's going to have to redo this installment agreement in the future because it just isn't going to work. The third kind of installment agreement is a little bit harder to explain. It's called a partial pay installment agreement, and it requires that I explain something called the collection statute of limitations first. See, all of us as taxpayers have a 10-year statute of limitations in which to pay back our tax obligations to the government. What does that really mean in English? Well, here's what it means. If you file a tax return and you have a liability that you owe the IRS only gets 10 years to collect that money. Now, there are things that can toll that time, which means stop it, and there's actually things that can add more time to that 10 years, but generally speaking, we all have 10 years to pay that back. But if you come in, for example, to our office and you're looking for help with your IRS tax problem, and you owe $70,000 and you have 3 years left to pay, it's probably not very likely that you're going to be able to pay that $70,000 back in that 3 years remaining. Now, in the old days, the IRS would actually coerce taxpayers into signing an extension of the collection statute for 5 more years. And thankfully, they really don't do that anymore. They almost never even ask for those extensions anymore. And I don't believe there are hardly any circumstances when you would want to sign such an extension. But the good news is, like I said, they're not really asking for those anymore. So back to my scenario, partial pay installment agreement, you owe $70,000, you only have 3 years left on the collection statute. What are we going to do? Well, the IRS is going to look at your collection information statement, your 433F, your 433A, your 433B if you're a self-employed small business owner, and they're going to determine how much you can afford to pay. So let's say in our scenario, you can only afford to pay, using their standards, $300 a month, and there's 36 months left on the statute. That means you would simply pay $300 times 36, and I don't have the math in front of me, but somewhere around $10,000 over that 3 years instead of the 70. So that's really a pretty good deal. But you really need some professional help in order to calculate that collection statute, how much time you have left, and help you through this process. Now, there's one catch and one kicker in a partial pay installment agreement, and that is that you actually cannot have any assets in excess of your monthly disposable income. So if you have equity in a house, equity in a car, things like that, then the IRS is not going to put you into a partial pay installment agreement. They're going to look for your equity in that asset. So those are the three installment agreement types. You got what I call the classic installment agreement, the streamlined installment agreement, and the partial pay installment agreement. If you have questions about this or really anything else pertaining to IRS tax problems, I invite you to visit our website at getirshelp.com.